Let's continue Chapter 30 with Section 2. We're going to talk about interest rates. So interest rates play this really, really big role in the financial sector in specific and in the macroeconomy in general. And it's just, I can't understate how important a variable, this variable interest rates are, because, well, for one thing, they convey an awful lot of information. Right? They tell us about what people expect in the future. They also tell us about people's time preferences. How impatient people are to be paid back. They also tell us something about a market's evaluation of the riskiness of a particular financial asset or its venture. So let's take a step back and talk a little bit about what an interest rate is. An interest rate is the price paid for the use of a financial asset. So really easy example. Let's say I decide to borrow from the bank $1,000 for a term of 6 months. All right. The interest rate that I will pay is how much the bank will charge me to use that $1,000 over the course of that 6 months. So we have what we call long-term interest rates, which is the rate that we pay for a financial asset with a long maturity. So let's break that down real quick. First of all, an important term here, no pun intended, is the term of the asset. And that is the time it takes until the asset comes to maturity. So that brings us to here. What is this maturity all about? Well, a financial asset is an obligation issued by some issuer. So let's say I decide to borrow $1,000. Then I'm issuing a loan, or I'm not issuing a loan, but I'm issuing a bond or whatever that financial asset is to someone who is lending, who's then buying that for the price of $1,000. Now, at the end of the term, let's say I borrow it for 1 year, at the end of that term, end of that 1 year, then that financial asset matures, which means I have to pay back the $1,000 plus the interest. So maturity means that the person who is, or the party who is obligated by the financial asset has to complete their obligations. And the term is the time which you have to do that. So we can see a few things that come in here. Let's say I borrow $1,000. Okay, for 1 year. Well, one of the things this interest rate tells me is if I borrow that $1,000 from you, how much I have to pay you to get you to give up being able to spend that $1,000 or delay $1,000 worth of consumption for a period of 1 year. So the first thing that I can see that an interest rate can tell me is how impatient the market is for waiting to, well, spend their money. All right, so that's the first thing. So there's a time preference in there that we can talk about. And then the second part of that is there's other risk involved, right? For example, I might not pay you back, so there's a default risk. There's inflation might be other than what you expect, so there's inflation rate risk. And if you take money in banking, we really dive in and talk about what an interest rate is all about, how interest rates are determined, the different parts of an interest rate. But for right here, what we've talked about is just enough. Okay, but that gives you a taste of why it's so important to know what this interest rate is and why that interest rate plays such an important part within the financial sector in specific and the macroeconomy in general. So the market for long-term financial assets is called the loanable funds market. All right, so we have this loanable funds market, which is essentially the market for money or funds that are loanable for a longer period of time. And by longer, let's say more than 1 year. Although we don't really have to be specific about what time period constitutes long-term, what time period constitutes short-term right now. Short-term interest rate is the price paid for a financial asset with a short maturity, all right? So a relatively short time to maturity. Let's say I want to borrow $1,000 from you for a month, right? That would be more of a short-term rate. Short-term financial assets are called money. This point right here and this point right here are kind of, well, they're pretty gross oversimplifications of the way the actual economy works. We'll use that for this chapter, but realize we're making some major simplifying assumptions here. Although we're not the first ones to do that. If we go all the way back to John Maynard Keynes, a very famous economist of the early 20th century, he basically developed a model that had two financial assets, money and bonds. Bonds were long-term, money was short-term. So let's talk about this market for loanable funds, or this loanable funds framework. Now, again, if you take money in banking, you'd see this in a whole lot more detail. But let's start out and realize this looks just like any other supply and demand market that you might have seen in Principles of Macroeconomics. It even looks a little like the aggregate demand, aggregate supply model that we've already seen in this class, right? We have a supply curve, it's upward sloping. We have a demand curve, it's downward sloping. We have a quantity of loanable funds, we have quantity here, and we have an interest rate here. And remember, an interest rate is just a price, so it's really like we have price here. This is just a market. Only difference between this market and markets that you've seen before is that this is the market for a financial asset, i.e. loanable funds, rather than a market for a real good. So this long-term interest rate's determined within this loanable funds market, and we can see it's just the interaction of the demand for loanable funds. All right, if I demand loanable funds, what does that mean? It means I want to borrow. And the supply of loanable funds. If I want to supply loanable funds, what does that mean? I want to lend. So it's the supply and demand of the borrowers and the lenders. All right, and if we talk about the supply being the those who want to lend, who wants to lend? Those are net savers. Those who save are the ones who are lending. That's where the loanable funds is actually coming from, is from people's savings. And those who want to do investment, all right, buy stuff to help produce other stuff, that's generally our demand for loanable funds. Although this is a bit of an oversimplification too, because we could demand loanable funds in order to consume as well. All right, but for right now, let's keep this nice and simple, savings and investment. All right, so if you'd like to see any more reading about interest rates and the determination of interest rates, this is a good article to take a look at. There's also several others, but this will get you started.